The Morgan Report with David Morgan.
David Morgan of themorganreport.com for the week ending 11 November 2022. Well, this Saturday, tomorrow, will be the third Silverfest. I will hopefully be able to make some opening remarks. I will be in Salt Lake City prepping for the Red Pill Expo, which I speak later in that day. I just want to shout out to Arcadia Economics and everyone involved with Silverfest 3. It should be probably the best ever. Chris Marcus, who founded Arcadia Economics, did write a book called The Big Silver Short. I believe I wrote the foreword in there, and lots of good information. Many of you are probably familiar with the book, but just in case you're not, it's certainly worth, in my opinion at least, the $23 to buy the paperback. So this is going to be rather brief. I've got to hit the road here momentarily, but I decided to make this weekly update or perspective based on a recent article from Nick Barishev, BMG Group in Canada. Nick and I have known each other for a very long time, actually pretty close to the time he founded the company. He wrote an article, I think it was on Gold Eagle, which was one of the only gold promotion websites during Web 1.0 way back. Anyway, reached out to him, and we've had a relationship for quite some time. Regardless, I like what he's done here with this article, Missing the Opportunity of a Lifetime. It kind of goes hand in hand with the last book David Smith and I wrote called Second Chance. That Silver made a massive move after the 2008 financial crisis. From that point up to 2011, it peaked out last day of April or first day of May 2011. It went from about 9 to 50 or close to it. And then gold peaked later, so silver led on that particular move. And then we've been in kind of this never land for the last decade. Gold and silver both acting strong of late, meaning just the last trading week or so. And again, reminding ourselves of the big picture. So what Nick says here is missing the opportunity of a lifetime. He shows decades of zero growth in U.S. stocks. Most investors have bought into Wall Street, always staying invested. While this strategy may work for institutions during a bull market, we have for the last 20 years today is not the best strategy for individual investors. While equity markets have made substantial gains, there have been 4 periods where stocks generated zero growth. So he's reminding you, here's something that we don't talk about enough. Nick put this out fairly often. If you lose 50% on a stock, it's got to double for you to break even. And that's why I usually use a stop of about 15%. You can absorb a loss in that area, but to absorb a 50%, again, the stock's got to double. Get down to 75%, then the stock has got to triple in order for you to break even. This is the inflation-adjusted S&P, which you can have a look at. You can see what happened between the all-time high on an inflation-adjusted basis with Japanese stocks in 1990, and they've kind of done what gold has done. They hit their high, different time frame, but the graphs are similar. Hits the high on a parabolic move up, and then it just comes down into this great big cup, and now it's getting close to the all-time high, but remember, a yen here is worth a lot more than a yen here. And this is 30 years later. It still hasn't gotten back to the all-time high. I'm going to skip this. Schuler, always good to understand. This is the housing market on aggregate. And what you find is, pricing of houses are basically, I should say real estate, overvalued, fair valued, or undervalued. You can see right now we're at the very much overvalued level. Even though it's been an up and down, which all markets move up and down, but up and down, up and down, up and down. It's pretty much, if you just kind of blend that curve, it's pretty parabolic, not as extreme as this one in 2008, but nonetheless started much lower from the COVID situation and all the way up. So beware. The Buffett indicator, all U.S. markets, I should say all, the U.S. markets on aggregate are overvalued. Real REITs, and I'm going to skip some of these. Let's see some of the biggest declines. When the S&P went down, as I've told you so many times, gold is inversely correlated. This is over, more than 8 days time frame. Obviously, you can read the numbers on the left, but when the S&P was off about 20%, gold was at 53. Pick another one here in the middle. The S&P off about 57%, and gold was up about 25%. So I would summarize this from my perspective, and that is, keep the big picture in mind and ask yourself the question, not only on an individual investor basis, a family office basis, an institutional basis, and a pension fund basis, if real estate is not the place to be, and stocks are not the place to be, and bonds are not safe, where do you go? And the answer is, go into the precious metals. Will there be some reemergence of the cryptos? Probably. There certainly could be. But I think the large money, the safe haven status of the precious metals is still intact. And I've put my neck on the line, which I've done many times. And that is, I do believe the run to gold has actually started. It's just basically in a stealth mode right now. But if you've read some of the articles lately, if you're familiar with all the financial markets and pay attention to the precious metals, you realize that there's kind of a quandary about who bought all this gold according to the World Gold Council's projected statement of how much gold was bought by central banks. So I'll leave it there. Lots of very smart people will be at Silverfest 3. I'm sure if you tune in for all of it, or at least part of it, you'll probably come back with more knowledge than you had going in. Again, my shout out to everyone participating in Silverfest 3, both on the side of those that are speakers and the side of those that are listening. So that's it. This is the end of my weekly perspective. David Morgan of themorganreport.com.